Hello, everybody. Welcome back to Beer and Money. My name is Ryan Burklo.
And I'm Alex Collins.
Today's episode, we're going to be talking about an over-concentrated stock position. Alex and I deal with this actually quite often, as many of our clients have work in tech and they've got either RSUs or stock options or grants or bonuses that come in the form of stocks, right? And that grows and grows and grows, and then it gets to us, and now they've got this huge portfolio invested in one company, and they recognize, okay, that's a bit of risk that maybe I didn't want. How do I get out of it?
Well, and just so you're aware, it's not just tech companies, but it's also places like Costco and Boeing and Weyerhaeuser and a lot of the big local firms around here. We wind up seeing folks with very significantly concentrated wealth positions inside of their own company stock.
And Alex, what tends to happen is this, at least in our experience, is when you're younger, the concentrated risk isn't that big a deal because it's really not that much of your portfolio. Then if the stock goes up and you're continually getting these more stock grants and they're vesting, next thing you know, 15 years have passed and you've got 3, 5, $10 million all in one company. And then you go, crap. Like,
Right.
if X company has a down year, that means a large portion of my assets have a down year. Then it finally hits. I've got this concentrated risk that I'm not sure I want.
Well, and like the other component of this is that there is this natural emotional, like, connection to the company that you work for, being one of the best companies. And it's not saying that they aren't. However, if 100% of your income and then maybe like, I don't know, anything more than 25, like anything more than about 10% of your net worth is also at that same company, we're now massively, massively tied to that one company. And there might be something that is totally out of your control, totally unforeseen, that has nothing to do with how well your company is being run or has been run, that might take it down.
And I'm going to take it one step further because I think many people, they forget this piece for whatever reason. And I think it's just so far in the future that it just doesn't cross their mind until it actually is occurring. You've got this concentrated risk and you're just like, you know what? I believe in the company. The AI is going well. Like, I'm good with this. Okay. What about 20 years from now?
Yeah.
Is the CEO changed maybe? Has the direction of the company changed? Like, are you still that confident? And when do you become unconfident? And will you be able to pull the trigger? Like, when you start looking at that aspect and the different timing that has to go perfectly for you to unravel it, it's
What
pretty impossible.
and here's the thing is that the vast majority of the time, it's not a, okay, we're done.
No.
Like these things take a lot of time and energy and effort to figure out what we're doing, which strategy we're using, why, what's the timing, what is our exit strategy. The planning work for that can oftentimes take a couple months. And then the implementation of that strategy, like A, can change over time, but B, usually we're looking at years of unwinding these types of components.
Yeah, and that's just it. You recognize it. Well, then you've got this low cost basis that you have to worry about, right? Then taxes come into play, right? It becomes a bigger mess than what we originally thought, right? And depending on the state that you live, it's not just federal taxes, it might be state taxes that you're also worried about.
Well,
So,
and like here's another caveat, Ryan. You threw out numbers like 3, 5, and 10. Well, if we've got a $5 million stock position and our company goes up by 8% per year on average,
right.
we're likely never getting rid of that position ever,
Yeah.
especially if we're continuing to receive shares, grants, dividends, uh, RSUs, however it is that we're accumulating company stock. We're never going to get rid of it. It's just a matter of like, okay, how much can we diversify away from it without causing massive tax headaches?
Right, because to your point, like here in Washington State, we've got this tax that affects us with long term, like with assets, specifically assets. And once you sell or have a an asset that you sell above and beyond a certain limit, 250K, like the taxes start to go up even higher. So it limits how much you will want to sell in any given year.
Hmm.
Even and you got this cost basis. So even if the stock is down, you can't do more than 250. You get an 8% rate of return on a $5 million asset. The asset's grown more than you can sell.
Yeah. Yeah, exactly.
And
We're talking about a
we're
$400,000
talking about
gain.
yeah, and we're
Yeah.
talking about a problem that on one hand is really good to have, and on the other hand is stressful because what happens if that stock does turn around quick?
Oh, yeah. Well, like, there was one client early on in my career where the company that they were tied to was a local company, and they loved their company. And it wasn't until we shared with them, "Hey, do you realize that for every dollar the stock moves, your net worth changes by $85,000?" And they were like, "Oh, oh, I yeah, I don't. Nope. We gotta do something different." And,
Yeah.
it's not that we disliked that particular company or that they disliked that particular company. They were just they got to the point where they were uncomfortable with how much it affected their net worth and their dollar amounts. And so it was just like, okay, yeah, it's time to slowly start unwinding this. And like they were very specific of saying, we don't want to get rid of it. And we were like, yeah, yeah, no, we can't in good faith suggest that you do because of the tax implications of that. And they were like, what do you mean? And we were like, let us show you. And they were like, oh my God, that's horrible. And this was before the $250,000 tax level and like before a bunch of the different things. And it was still a horrendous tax bill that they were going to experience if they liquidated all of it. And so we created this structure that had them sell it over time, and like it worked beautifully.
So, Alex, I think we've done a pretty good job of explaining what the risk is and the tax implications, right? What are the concerns? Let's start going into planning considerations on how to unwind and over concentrated risks. First and foremost, if you're still working, right, you still have these future vesting. Like if you're getting RSUs, you're getting these future stock options. A great way to do it is as they vest, maybe sell maybe all of them, depending on the concentration and the risk that you want to have. And then when you sell, now you reinvest it somewhere else, therefore diversifying your portfolio. And in its simplistic manner, that's very simple, but also it depends on how big is that egg that you've accumulated.
And it also depends on like, okay, what's the taxation structure? Like there are multiple different taxation structures. The most common one that we see around here is RSUs, where when it vests, you pay the taxes on the vested value, and so you can just turn around and sell it. And if you turn around and sell it, like at that point, there's no additional taxation. You're subject to taxes, but you're going to be subject to taxes whether you sold it or not.
Yeah,
So the selling of it doesn't impact you one way or the other. Now, if it's a stock grant and you've got a low basis that you inherit with it, like, ooh,
that's a different ballgame. Yeah.
100%. And so, like, this has to be a conversation with your tax advisor, with your financial planner. You want these people to be working on these things together in concert so that you don't wind up with unintended tax consequences.
And let's just put a little like pause there because too often you and I see either the client was working with another advisor and that advisor told them to sell. And maybe it was the best thing. We're not saying that that advisor was wrong, but there was no coordinated plan with the CPA in that manner. So the CPA wasn't aware of it. Then the CPA starts freaking out. Like it becomes kind of a giant mess. And guess who gets to really inherit that mess?
The client.
The client who's in the middle.
Yeah. Now you're playing telephone between five different professionals or whatever, and it becomes a headache. And yeah.
Right. So make sure you are coordinating or you're working with someone that will help you coordinate your different professionals so that they're all on the same page and you now aren't you, the client, aren't stuck in the middle trying to play that role. Because now you're playing a role that, no offense, you don't really have, you shouldn't be playing. Otherwise, you'd probably be doing that for a living.
What you became your own general contractor
Yeah.
for finances.
Yep.
Like, um, if it's not something that you have half a decade to a decade of formal training in, good luck.
Yep.
And that's not to denigrate anybody out there who's doing it themselves. It's just the I wouldn't want to be doing my own dentistry.
No, no. Even with AI, I wouldn't even want to do my own dentistry. AI is coming a long way. Don't get me wrong, but man, the questions that you have to ask it to get to it, you don't know what questions to ask it. That's the problem.
Yes, 100%.
So, anyways, this isn't an AI episode. So the other thing that we can do is obviously sell the concentrated risk, which we've already gone into, and then you got like the when, how, and why, Alex.
Exactly. And so that needs to be a calculated discussion. And the idea and the goal is to try and take emotion out of that decision and discussion as much as possible. I mean, we're emotional creatures, so we can't truly take it out. But at the same time, we want to try and take as much of the emotion out of that decision making, because whenever we allow emotions to dictate our decisions around finances, they typically work against us. That not that
Yeah.
emotions are bad, they just are bad when it comes to financial planning.
Yep.
Um, so we need to make sure that we're creating a systematic plan for when, how, and why, and making sure that it's addressed ahead of time and not just, oh, well, I'll sell when I feel like it. It's kind of like that. I'll get around to it, and no one ever gets around to it. Um, and there's also several strategies that don't involve selling.
Yep. So let's talk about the not selling one, right? Let's just talk about, and we're going to call it an option straddle,
Mhm.
right? So Alex, I'll let you kind of explain what at a high level. We're going to do a whole nother episode on these two pieces, so we're not going to get into too much in the weeds here. But option straddle, Alex, what does that look like?
Sure. So the idea is that we're trying to create protection on the downside. We're creating ourselves a cap on some or all of the position on the upside. As a result, we can wind up creating some cash this way. There's a couple different ways to go about doing this, depending upon what the stock is and what the volatility is, and a bunch of other factors. But the idea is that we ideally wind up creating some cash and protect ourselves on the downside. It will limit us on a bit on the upside, but most of the time clients are willing to go ahead and limit themselves either partially or fully on the upside to protect themselves from losing on the downside, once they understand it and once they look at it and really get wrap their heads around what it is and how it works. So that's an option. Um, there's also the exchange fund option, where there's kind of a couple different versions of this. There's the outright exchange fund, and then there's exchange fund replication. So we can the exchange fund. The issue is we wind up with a significant lack of liquidity, and lack of choice around what we wind up being paired with. Um, and when we get to replication, now we're going back to the options world. We've got more choice. We've got more flexibility. We can tailor that a little bit better. But again, we're trying to protect ourselves against the downside, and we may or may not be limiting ourselves on the upside.
Yeah, essentially, it's a fund that you're paired with other people in your situation that have maybe different companies, and now you can diversify that a little bit better, utilizing a fund type of structure or replication of that type of fund. So there are plenty of considerations to look at, both selling, both with future options that might come your way, as well as not selling. And so, but the big takeaway that we want to have is understanding these pieces, right? And understanding one, the risk that you have, two, what you can and want to do with it, and then last but not least, how to implement that with minimizing the risk, the taxation in the most efficient way possible. So we wanted to bring this into play because unfortunately we have this happen every year. And so we want to make sure that we are being proactive as we possibly can. So today's episode, make sure you share this. If you work at Amazon, Facebook, like these companies that have this type of structure in their compensation, share this episode, right? Because at least bring this to the forefront of everyone's education so that they can take proactive steps rather than ending up at retirement and then maybe freaking out over something and making a wrong decision,
Mhm.
which is the whole purpose of us even starting this podcast, Alex, is making sure we're helping people design the life that they want and hopefully giving them some actionable steps to do so.
Absolutely.
So head over to beerandmoney.net. Top of the page is to contact us. If you have questions from this episode, that's a great way to reach out to us. If you have a topic on your mind, that's a great way to reach out to us. And then lastly, as always, in the show notes is a scorecard. If you want to get your own financial scorecard, there's a link there. Go there. You get your own scorecard at the end as you're putting in your information. Alex and I do not see this information, so that we're being clear. We don't see it unless there's a button at the end that you can say, hey, share with Ryan and Alex and have them reach out to me. We don't get that. So check out that scorecard. As always, we hope this episode is valuable for you. And Mr. Collins.
Cheers.
This podcast is for informational purposes only and is not to be construed as tax, legal, or investment advice. Although the information has been gathered from sources believed to be reliable, please note that individual situations can vary. Therefore, the information should be relied upon only when coordinated with individual professional advice. Guest speakers and their firms are not affiliated with or endorsed by Park Avenue Securities, Guardian, or Quantified Financial Partners, and opinions stated are their own. Guardian, its subsidiaries, agents, and employees do not provide tax, legal, or accounting advice. Consult your tax, legal, or accounting professional regarding your individual situation. All investments and investment strategies contain risk and may lose value. This material is intended for general public use. By providing this content, Park Avenue Securities LLC is not undertaking to provide investment advice or a recommendation for any specific individual or situation, or to otherwise act in a fiduciary capacity. Please contact a financial representative for guidance and information that is specific to your individual situation. Ryan and Alex are registered representatives and financial advisors of Park Avenue Securities LLC, OSJ 200 Market Street, Suite 1850, Portland, Oregon 97201. Phone number 503-221-1226. Securities products and advisory services offered through Park Avenue Securities, member FINRA, SIPC. Financial representatives of the Guardian Life Insurance Company of America, Guardian, New York, New York. Park Avenue Securities is a wholly owned subsidiary of Guardian. Quantified Financial Partners is not an affiliate or subsidiary of Park Avenue Securities or Guardian. Ryan Burklo, CA Insurance License Number 0K24924. Alexander Collins, CA Insurance License Number 0H24806.
8672588.1, expiration date December 2027.